Warren Buffett has said the average person could outperform most Wall Street professionals, yet 57% of Americans still aren't investing a single dollar. Let's start with the most talked about investment on the planet, stocks. When you buy a stock, you're purchasing a tiny slice of ownership in a real company. If that company grows and becomes more valuable, your slice grows too. Companies can also share their profits directly with you through payments called dividends. The appeal is obvious. Stocks have historically delivered stronger long-term returns than almost any other asset class. But here's the catch. Prices move constantly based on news, earnings reports, and market mood. Your emotions become your biggest enemy. Fear pushes people to sell at the worst moment. Greed pulls them to buy at the peak. Stocks are powerful, but they demand patience and discipline. Next up, bonds. Think of a bond as a loan you give to a government or corporation. In return, they promise to pay you regular interest over a set period and hand your original money back at the end. Bonds are the calm, steady option. They don't swing wildly like stocks, which is why more conservative investors and retirees lean toward them. Government bonds from stable nations are among the safest investments in existence. The downside is that safety comes with lower returns. Also, when interest rates climb, bond prices tend to fall. And not every bond is low risk. So-called junk bonds offer higher yields, but carry a real chance of the borrower defaulting. Know exactly what you're buying before you buy it. Now let's talk about mutual funds. Imagine pooling your money with thousands of other investors and handing it all to a professional manager who picks stocks, bonds, and other assets on your behalf. That's a mutual fund. The biggest benefit is instant diversification. If one holding crashes, the others help cushion the blow. This makes mutual funds great for beginners who want broad exposure without doing heavy research. The downside is management fees. Even small fees compound over decades and quietly drain your returns. Actively managed funds frequently underperform the overall market, especially once those fees are deducted. You also surrender all decision making to someone else. And here's where it gets interesting: index funds and ETFs. An index fund simply mirrors a market index like the S&P 500, which tracks 500 of America's biggest companies. It doesn't try to beat the market, it just matches it. That means lower costs, fewer trades, and historically solid long-term performance. An exchange-traded fund, or ETF, works similarly, but trades throughout the day on the stock exchange like a regular stock. Both options give you ownership in hundreds of companies with a single purchase. They're simple, affordable, and wildly popular for a reason. The risk is that when the whole market drops, you drop with it. Some sector-specific ETFs also carry higher concentration risk. Real estate is one of the oldest wealth-building tools in history. You buy property, rent it out for monthly cash flow, and watch the value appreciate over time. You also get tax advantages that most other investments can't match. The psychological appeal of owning something physical and tangible is real, but so are the headaches: large upfront costs, unpredictable tenants, surprise repair bills, ever increasing property taxes, and the reality that you can't sell a building in 5 minutes if you need cash quickly. Want real estate exposure without the landlord stress? REITs, or real estate investment trusts, solve that problem. These are companies that own income-generating properties. Everything from apartment complexes to warehouses and data centers. You invest in them through a brokerage account just like a stock, because they're legally required to distribute at least 90% of their taxable income to shareholders. They tend to pay generous dividends. The main vulnerability is rising interest rates, which make those dividend payments less attractive to investors. Cryptocurrency is where things get genuinely wild. Bitcoin, Ethereum, and other digital currencies run on blockchain technology, a decentralized network with no government or bank in control. Early adopters made life-changing fortunes. The potential upside is massive and the market never sleeps. But prices can swing 50% in a matter of days. Regulations around the world are still unclear and evolving. Lose access to your digital wallet and your investment is simply gone forever with no way to recover it. Commodities cover physical raw materials like gold, silver, oil, wheat, and natural gas. Investors use them primarily as a hedge against inflation because when the value of paper money falls, tangible goods often hold their value or rise. Gold is the classic example. The problem is that commodity prices are influenced by droughts, wars, and global supply chains, making them incredibly hard to predict. They're generally not beginner friendly and often require specialized trading knowledge. Options and derivatives are the advanced tier. You're not buying an asset, you're buying the right to buy or sell it at a specific price within a specific time frame. Call options profit when prices rise. Put options profit when prices fall. The leverage involved means small moves can produce massive gains. But if your timing is off, your entire investment can expire worthless. These tools are powerful but genuinely dangerous without deep understanding. Certificates of deposit, or CDs, are the opposite end of the risk spectrum. You lock your money in a bank for a fixed term, typically several months to a few years, and receive a guaranteed interest rate in return. Your deposit is federally insured. Returns are predictable. The only catch is limited flexibility. Withdraw early and you'll pay a penalty. Returns are modest compared to the stock market, but for short-term savings goals or risk-averse savers, CDs make real sense. Private equity and venture capital involve investing in companies that aren't publicly traded. Private equity targets established businesses needing capital for growth or restructuring. Venture capital bets on early stage startups with explosive potential. The rewards can be extraordinary. The risks match that scale. Most startups fail. Your money gets locked up for years. These opportunities are generally reserved for high net worth accredited investors. Finally, art and collectibles. Rare sneakers, vintage watches, fine art, trading cards, all of these can appreciate dramatically in value. Their worth is driven by scarcity, cultural relevance, and demand. The challenge is liquidity. Finding a buyer takes time, pricing is subjective, and you need genuine expertise to separate real value from pure hype. These belong in a portfolio only after the fundamentals are covered. Every investment carries a trade-off between risk, reward, and time. Understanding all your options puts you miles ahead of most people. Now go make your money work for you.